What's up everyone, welcome back to another video with the Millennial Finance. I'm going to be showing you guys some basic technical analysis and how I use it to time my buys and sells for investing. Cha-ching! So what is technical analysis? It's basically a methodology to forecast future prices based on historical market data. Some people think it's a scam, while others swear by it. I use it for both long-term investing and a bit of swing trading. I'm not an expert and I'm actually not doing very well trading, but I do know how some of the basic stuff works and I really use it on my day-to-day when I'm buying and selling stocks. Based on my experience, it's impossible to be 100% accurate in knowing whether the stock price will go up or down just based on technical analysis. The truth of the matter is, no one will know where a stock can go. Stock A can have the perfect technicals for it to shoot up, only for a bad piece of news to come out and the stock will go cratering down. Technical analysis is just a tool that helps us guide and gives us a feel of where the market will go, but it's in no way guaranteed. For this reason, many people think that technical analysis is completely useless and fundamentals are the only thing that matters when buying a stock long term. While I agree that fundamentals are key, I do think that technical analysis can be used to help you time entry positions and sell when the stock has made a run too far. So, in terms of platform, I use this website called TradingView. In my opinion, this is the best software out there for you to do charting. It's because it's free. There is a free version and it's good enough for a lot of people to use, and most people won't even have to go to the paid version. I currently don't pay for this, but moving forward, I'm looking to buy it as I want more indicators and more advanced features. You guys can check it out. There's a lot of details on the pricing and how it works, but if you guys want to sign up, you can use our link down in the description below and you can help support the channel. So there's a lot of technical analysis out there and it can be very complicated. There's stuff like Elliott waves and Fibonacci retracements, but for the purpose of this video, I'm going to be keeping it very simple, and it's more of a beginner's guide on how to use charts to help you with investing and trading. So we can see here, this is my watch list. When I click onto it, it'll go on open a chart that looks like this. TradingView is trying to ask me to upgrade so there'll be no ads on my chart, but you know what? I love ads, so close. Okay, so this is how a chart looks like. You guys must have seen this before. It's all over. People like to post it whenever they think it's a good time to buy the stock. But before we even get to any technical analysis, what do all these stuff mean? What is this green thing, red thing? I mean, a lot of people know that the higher it is, the better, of course, but there is a story behind these candlesticks. So let me explain. There are two types of candlesticks. It's either green or red. If it's green, it's a bullish candlestick. If it's red, it's bearish. So when we go back here and we see a green candlestick, it means that the stock opened at the bottom of this bar and it closed at the top of this bar. This wicks that we see here is the high of the day and this is the low of the day. If the candle is red, it means that it opened up here, closed down here, and the high and the low is the same. So let me show you guys for C Limited. Let me just zoom in real quick. All right, let's look at this candlestick here. You can see at the top left here what it shows. O means open, H means high, L means low, and C means close. So on this day, the 25th of March, C Limited opened at $190. It had a high of the day of $204, low of the day of $189, but it closed at $202. So it opened at $190, closed at $202. It went up in a day. That's why the candlestick is red. Sorry, I mean green. If the candlestick is red, you can see here on the left, 24th of March, one day before, it opened at 218 and it closed at 197. So it closed lower than it opened. That's why the candle is red. All right. So I hope you guys understood that simple explanation of how candlesticks work. If you don't, go back, rewind this video, relearn it, take down notes, draw the candlesticks yourself, and I'm sure that you guys will get it because it's pretty simple to understand once you get the hang of it. Okay, so now that we know how candlesticks work, green means good, red means bad. If you own a stock, you want it to be green and you want it to go as high as possible. So you can look at C Limited, $40 back here in April 2020. Today it's $250. All right, the next important thing, and I think this is one of the most important indicators is volume. So you can see here, I have this volume bars down here. This basically means how many shares were traded for the stock during this day. So why is this important? If the stock is green and it goes up by a lot, right? Let's say on this day, it went up by 8.3%. We want to see it being bought up in heavy volume. So you can see this bar here is very big. It's because a lot of people bought, and it gives the stock confirmation, meaning the price didn't just go up because there were no sellers and it was a one-off. It actually went up because there were so many people buying and there's very strong interest in the stock. So what we want to see is on green days that the volume is very high, and on red days when the stock goes down, because all stocks of course have to go down from time to time, the volume is very little. So you can see here, big green day, smaller red days, smaller red days. And here, when there's a big red day here, you can see the stock went all the way from here down to the 190 mark. So when it builds up this right side, you can see that the green bars aren't great. The volume isn't very high. If you want to see a good example of a stock with very strong volume on the way up, let's look at Square. And you can see here, as it went up, the volume is actually very, very high compared to the last, 10, 15 days. So this is what we want to see when looking at volume. Basically, when the stock makes a big green day up, we want to see it with heavy volume, not just with very little volume, because that's not a sign of confirmation. So now that we've gotten through the candlestick and the volume, this is the most basic stuff. And I think even if you just know that, that'll be great. But let's get into stuff that is a bit more complicated, being moving averages. So how do moving averages work? I got a sample for you here. So let's say this is a stock. It's been trading for 5 days. Today is day 5. And in day 1, it's $10. Day 2, 9.5. Day 3, 9. Day 4, 7.5. And then day 5, 8.5. So a 5-day moving average will just basically mean that we take the average of the last 5 days, and we get that the average price of this stock is $8.9. So this is a 5-day simple moving average. If it's a 10-day simple moving average, it just means that basically what is the average price of the stock for the last 10 days. You don't really have to be concerned about calculating the average price, because of course all of these charting softwares have this ready. So I'm just going to unhide this here, unhide and unhide. So there's 2 different kinds of moving averages. One is called the simple moving average, which I just showed you. It takes the average price of the stock for the last 5, 10, 20, 50 days, whatever you want, you can decide. But there's another one called exponential moving average, where they call it EMA, and it's basically nearly the same thing. It takes the average of the last 5 days, but it puts more weightage on the earliest day, which is today, day 5. So less allocation to day 1, more allocation to day 5. For me personally, I think that exponential moving averages are better for 10 or 20-day moving averages versus the simple moving average for 50 or 200-day moving averages. Let me just show you how to put it in a chart. So you can see here that I have 3 moving averages. I put the 10, 50, and 21. These are the most common ones, where the 4th most common one is the 200-day moving average. So how do you set this in TradingView? You just basically indicators, you type in moving average, and you can have moving average or moving average exponential. You click that, you click into the settings, and basically you can set the moving average day for however long you want. Like I said, the most common ones are 10, 20, 50, or 200. So right now on my chart, I have the 10, 50, and 21. I don't have the 200 because I can only set a maximum of 3 since my TradingView is on the basic plan, but once I've paid for it, I can set as many as I want, and I have the 200-day moving average up as well. So why is the moving average important? Well, basically it acts as a very strong support and resistance for a lot of stocks. And for a stock to be bullish, it needs to be above the 50-day moving average. That is a general rule that a lot of investors and traders live by. So my 50-day moving average is marked by this blue line here. You see it moves every single day, it will change. And if you move back to C limited in the last 1 year since it bottomed in March, you can see that this stock is just riding on these lines. The 21-day moving average, it goes up and it comes back down. At the 21-day moving average, it moves back up, goes back down here, and at all times it's above this blue line, which is a 50-day moving average. When it has a big drop, we can see here in September, it finds support at this 50-day moving average. You can see here, perfect. Here it goes down a bit below that, but it goes back up. And finally in February and March, because it was a very bad month for growth stocks, it pierced through it and it went very, very low after that. It tried to go back up, but the 50-day moving average is now a resistance. It falls back down, and now it's back above the 50-day moving average, which is a bullish sign. I can show you guys examples of other stocks. You can take a look at Roku. Again here, ever since March, find support at the 50-day moving average, all the way back up, and once it pierces below, it drops all the way down. So what we want to see is for our stock that we're holding long term is to be above the 50-day moving average, and if it can be above the 10 and 21, even better. So how do we use these moving averages for investing? Let's say in October, I decided I want to buy C Limited, and you can see on the 9th of October, it's very far away from the 50-day moving average, which is this blue line. If I wanted to start a position, maybe I'll start a small one when it drops to this 21-day moving average, and then I'll build my bigger position at the 50-day moving average. Just remember that all stocks will always go back down to these lines. It's impossible for them to go up forever and forever be above the 50-day moving average. It's impossible. So just remember that they will revisit it one day. So if you want to build a position and you think that stock is already too high, just wait for the retracement back here, and then we can build our positions. You can see it goes all the way back up. So let's say if you bought a small position here, it goes up, you don't want to buy, it drops back down here, you can buy again. That's generally how you can use these moving averages. It's one of the most basic tools, and I think it can be very useful for a lot of you. And I personally use it a lot of the time as well. Another example of me using this moving averages is, for example, in this stock here, Twilio. So it's here right now. I don't want to buy it because the 50-day moving average is just above it. So I want to see if it gets rejected and goes back down before buying, or if it manages to break through. So for example, let's say it's the 15th of March. You don't really want to buy here. You want to see if it can break past, because if it can't, it'll drop back down. So you see in this example here, it tried to break through, it couldn't, it dropped back down, so we should be buying here. Right, so same scenario here, we don't want to buy it yet, we want to see what it does after meeting this 50-day moving average. Stocks like C Limited, they managed to break through, perfect, I'm going to buy. So that's how you use moving averages. The next one I want to talk about is support and resistance. This is another very basic technical analysis, and it's basically these lines I'm drawing here. These lines are things I drew myself. What support and resistance means is, imagine a stock that's going up. When it drops back down, there is this level of support that the stock drops, it finds support, it bounces back up. Resistance is the opposite of it. So this is the resistance for the stock. It tries to go up, this is resistance. If it can't break the resistance, it drops back down. So these are lines that we draw very simply just based on technical analysis. So let me explain why it works. Let's go to this stock here, Twilio. I'm going to show this chart, and you can see this line that I drew here at $331. Back in October, it tried to break through and it couldn't. So this is what it means, what is called as resistance. There is some resistance here, so it couldn't break through, it fell back down, it tried to go again, it broke past it. So when we break resistance, it now becomes support. So it breaks resistance, and now you can see here, it's support. It drops back down here, support, drops back down here, support, drops back down here, support, and this one, it actually pierced through a bit more, it goes back up. So this is a very classic example of support and resistance. Why does it work? Imagine the stock price is here now, and we're on the 16th of December. I am a big fund. I am Warren Buffett, and I know that I love this company, Twilio, but because I have $100 billion, I'm not going to buy at any price. I'm only going to be buying at a price that I'm willing to pay based on my fundamental analysis and a valuation analysis. So let's say I'm Warren Buffett. I want to buy Twilio Today it is $353. I don't want to buy it. I decided that I'm only going to buy it at $331. Right now, I'm Warren Buffett, I'm not going to buy. When it drops here to $331, I'm like, okay, this is the price I wanted, I'm going to buy. So I buy, it goes back up, I'm not going to buy. It drops back down here to $331 again, I'm Warren Buffett, I'm going to buy again. This is why support works, and this is actually something that I really believe in. It's not some made up stuff that people just draw lines. It's really something that makes a lot of sense, at least to me. And the same can be said for resistance. So let's say I'm Warren Buffett now, and I own this stock called Medtronic ever since July, right? And based on my fundamental analysis, the stock is only worth $120. Anything above that, I don't think it's worth it anymore. When the stock hits $120, I'm gonna sell. And because I'm Warren Buffett and have so many shares to sell, I will be able to actually prevent the stock from going up above $120. So you see here, resistance, 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 and every single time the stock comes close, I'm going to sell. And I have 1 billion shares, so I have unlimited or nearly unlimited supply of stocks. Every time it touches, I'm going to sell. And finally, on the 5th of April 2021, I ran out of stocks to sell. As the biggest seller all this while, I suddenly have no more stocks. I've sold all my positions, which means the buyers are stronger than the sellers. So once it breaks through this line, me as Warren Buffett, I no longer have stocks to sell. The price can finally start flying up, and I actually bought this share to swing trade, but not financial advice. You guys have to do your own analysis. I don't know if it'll work, but yeah, that's how support and resistance works. Again, can be very complicated. I don't know if I explained it very well. If you guys can get it, rewind, watch it again, and let us know down in the comments below if you have any questions. Also, you can hit us up on Instagram at the Millennial Finance if you have any questions. So the next part that I want to talk about basic technical analysis is what people call basing. Imagine a stock goes up. You see, stocks can't go up forever. It's like, you know, when you're climbing Mount Kinabalu, you go up, 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 but you can't go from the bottom to the top in one day. Right? You want to rest, you need to base. That's exactly the same as how stocks work. It needs to base. So let me show you an example. Nvidia, right? So the stock from March went from $200 straight up. This is basically nearly straight up all the way to $520. This is more than 100% returns. But a healthy stock will always base. So you can imagine they are climbing Mount Kinabalu, climb, 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 climb. We're tired, we need to rest. So you can see that the stock is just basically trading in this range here, right here, right here, and this is my base. I'm no longer going up, I'm just resting, 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 resting. We tried to continue climbing, then we realized we were a bit too tired, so we went back down to base again. And right now we're still in this base that Nvidia is building. Personally, what I really like to do is I like buying stocks when they are basing. So I've been buying or accumulating a lot of shares of Nvidia during this basing period, and this is what we're looking for when trying to build a long-term position for a stock. Another one, but with a more extreme example, is Teladoc. So you can see, again, from 2019, $50, it went up basically in almost a straight line all the way here. And now the climbers are tired. They're basing at this level here between these two lines. So it's resting. It broke through in January, but because stocks are selling off, it got a very bad downturn. But again, goes back to our support and resistance lesson. It stopped at around support. And this is where I actually bought a lot more of Teladoc. To be honest, I'm currently down because we're at the bottom of the base. What we want to see now is for it to go up above our moving averages and hopefully break through this base and finally be ready to start climbing Mount Kinabalu again. So this is a concept of basing. There are more advanced stuff that you can search up. There's first bases, second base. Now I realize that sounds wrong, but yeah, stocks have first base, second base, third base. A lot of these stocks are still at their first bases ever since they're up. See, C limited here. It never based all the way up. And now we can finally see that for, 2-3 months, it's hovering around the same level. So this is a good example of when we want to start accumulating some shares. So I've given you guys a lot of examples of when to buy stocks. I've talked about moving averages. We want to wait for the stocks to go back down to buy, about support and resistance, about basing, and basically just telling you guys don't chase stocks when they're going up. On green days, we want to take a look at our positions and maybe even trim if it's gotten too big. And we want to buy on red days. So on days like this, we want to buy. But when do you sell? What if a stock goes up too much, too fast, and it's probably a good time to sell? So this is just my personal opinion. A lot of people disagree, but I stand by this. So let's say we take an example here, a stock called Lemonade. It IPO'd, it went down, and you can see from here on onwards, from 7th of December, we get a ruler out here, from 3rd December, all the way up here. In just 39 days, this stock went up 175%. And you can see this very big green bars, very big. So in one day, it went up 27%, 5%, and then 14%. These are very, very big moves. And usually to me, when there are very big moves consecutively like this, you see big move here, big move here, here, here. It usually is a sign that the stock is reaching its top. And I'm not going to say I'm a genius, but I sold Lemonade right around this level here. Made a good profit. I liked the company long term, but I just knew that it had to go back down, and that's exactly what it did. Went down all the way back here. So again, in big moves like this, you especially do not want to be buying. You should consider selling, but if you want to hold the stock long term, that's up to you. I decide to sell when there's big moves like this. And you can see this example in actually a lot of stocks. Another one that I own is called Fubo TV. You can see I bought it at around this level here, $27. A nice small base for a while, of around maybe half a month. It was basing, so I thought good position to start. I like this company. Get my ruler out because I'm a nerd. 16th December to here. In 6 days, 121%. That's not normal. Okay? And we see the exact same thing with Lemonade. 12% move up, 18%, 11%, 26%, and then 25%. That is not normal. When the stock did this, I basically just sold it at around the $56 mark here. Because I knew that this is not sustainable. Even though I loved the company, it just doesn't make sense. This is a classic sign of a stock that is nearing its top, at least for the short to medium term. So again, we don't want to be chasing. Of course, if you bought it here, you still make money, still make money, still make money. But this is in hindsight. We never know what will happen. You know, what if you bought here and bam, in just a few days, you'll be losing nearly half of your money. So this is a sign for me to sell. Again, I sold Fubo here. I'm not saying I'm an expert. Dropped all the way back down. Classic sign, all the way back down. So I showed you guys what we don't want to be buying and when we want to trim. So this is not how a normal stock works, right? If it goes up too much, it's not normal. We don't want to hold it long term. What is a normal move up, right? Let me show you guys. Again, going back to C Limited. This is a normal move. Right? It almost looks like you're walking up the stairs. Walk up the stairs, walk up the stairs slowly, 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 slowly. Right? It's a very slow but steady move upwards. There's no way that a good stock can just keep going up very fast forever. It's always in like a stair-stepping motion. It goes up slowly. So this is an example of a stock that is healthy. It's going up slowly and steadily. And yeah, this is what we want to see. So no cause for concern. I didn't really have any reason to sell, so I held my C Limited for a very long time. Again, just going back to show Fubo, this is not normal. This is not walking up the stairs. This is taking the elevator, and we can't take the elevator when buying stocks. So I thought it was time to sell. Still, I love these companies. I like Fubo. I like Lemonade. I'll be looking to reinitiate my position. It's just that it'll be later on. So this is how I basically invest my money, but also use a bit of technical analysis to guide me when to buy and sell, because sometimes things just don't make sense. People get overexcited. So you should take advantage of that. And yeah, that's just my personal opinion. And I wanted to show you guys how it works. I honestly thought it's going to be basic technical analysis. Then I did this video and I realized that it's not basic. It's actually quite complicated and difficult. But still, I really hope you guys learned at least a bit from it. feel free to rewatch it. And as I said, hit us on Instagram. You can DM us and we'll be happy to reply at any time. If you guys want to sign up, check out TradingView. It's one of the best platforms out there. Honestly, we are not even really going to make money from it because, as I said, if you're a long-term investor, you don't even have to pay for the plan. Just take the free plan and start looking at these charts. So you can use our link to sign up so that if one day you decide to upgrade, we'll make a bit of money from it. Let us know down in the comments below. Do you think technical analysis works and do you use it for your stock investing method? Hope you guys enjoyed this video. Give us a big thumbs up and subscribe to our channel if you haven't already. See you guys in the next one. Peace out.